In this month's Economic Update, Kaplan Professional Education's Victoria Papandrea speaks with an industry economist about the short-term domestic and global economic outlook.
Welcome to Kaplan Professional Education's September Economic Update. I'm Victoria Papandrea and today I'm speaking to A&P Capital's Chief Economist, Shane Oliver. Shane, thanks for joining me today.
Thank you.
Firstly, Shane, the RBA recently said it's keeping a close eye on the strong Australian dollar and flagged it as a new risk for the economy. What are your thoughts on that?
Well, I think the Reserve Bank has become concerned that the rise in the Australian dollar we've seen since May has occurred at a time when commodity prices have actually fallen. Therefore, it's mainly driven by capital flows, and consequently, if it continues, then obviously it could be more of a drag on the economy than might have been the case in the past when the Australian dollar was highly correlated with commodity prices. I think the Reserve Bank is right to be concerned. Do I think they should intervene to do anything about it? I think probably not at this stage. The divergence in the Australian dollar from what the terms of trade and commodity prices have been doing isn't that extreme. If it continues, then I think the environment will change somewhat. If the Aussie dollar just keeps powering on higher, even though commodity prices have come off, then at some point, yes, it will be a dampener on the economy. My feeling, though, is that the best thing the Reserve Bank can do is cut interest rates, because that will not only take some of the pressure off the Aussie dollar, but it also take some of the pressure off the struggling parts of the economy, such as housing, retail sales, manufacturing and so on. I think a second best approach would be to intervene, which some people are talking about, where they actually go into the foreign exchange markets and try and push the Aussie dollar down. The problem with trying to do that is that it just may not be successful. So my preference is that lower interest rates are probably a better path to take, but I can certainly understand why the Reserve Bank is concerned.
The profit reporting season in Australia got off to a disappointing start in August with mixed results. Can you shed some light on what occurred?
Well, through August, the profit results have been somewhat depressed compared to what we've been used to over the last few years. Profit growth has virtually disappeared, and in fact, for resources, profit growth went backwards quite substantially. At the end of the day, though, the results weren't particularly surprising. We did expect that the resources sector would be one of the worst sectors, and that certainly was the case, and that's on the back of the fact that commodity prices have fallen at a time when they've got big investment programs, but they've also got cost blowouts on those programs. So all of those things have come together in a bad way for the resources sector, so no great surprises there. And likewise, when you look at the banks, they're sort of meandering along, very modest profit growth, and of course the industrials, a similar story again. One of the interesting themes to note was that as we came into this profit reporting season, in fact over the last 6 months, we've seen many of the defensive parts of the market rally very hard. And of course they were almost priced for perfection. So any defensives which disappointed or even just came in line with expectations, they saw their share prices sell off. By contrast, cyclical stocks which have been sold down very hard prior to the reporting season, any of those which surprised on the upside tended to do pretty well. So you've seen a bit of a rotation in the market away from the expensive defensives, more towards some of the cyclical parts of the market.
Shane, can you bring us up to speed with the latest developments in the Eurozone, in particular the impact that rising government bond yields are having on Italy and Spain, and what this could mean for those two economies?
Well, almost for the last 3 years now, Europe goes through this process, or this cycle almost, of revulsion. Investors get revolted at worries about Europe. They panic, bond yields are pushed higher, then you get some sort of response from the authorities, and then you get a bit of relief. And of course, we're still in that cycle, almost 2 steps forward and 1 step backward, of course against a weakening economic backdrop in Europe. So there's no doubt that Europe is in trouble. Lots of concerns there. It's the weakest part of the world. Economic growth is negative, so it's in recession. And of course the big worry was that if they don't get their debt problems under control, then that will make things even worse. I think what we have seen is that the European Central Bank moving to work in concert with the European bailout funds do offer the promise of trying to get some of those debt issues back under control. Yes, Europe has to get its debt down, particularly the peripheral countries like Italy, Spain, and of course the early ones that ran into trouble. Greece is still there, and Portugal and Ireland. So those issues are still there. I think the critical issue, though, is for the European Central Bank and the bailout funds to act together to bring down the bond yields in Spain and Italy. And we have seen some progress on that front. I think still a bit further to go, but at least that progress does provide some confidence that Europe won't spiral on down into a deep recession, but yes, it will still have a mild recession. But if that's probably okay, the world can survive that. But I think the critical point here is that the European policymakers do seem to be starting to move in the right direction.
Moving on to Asia now, inflation in both China and India has slowed. Shane, do you think this will prompt policymakers in these economies to do more to boost growth?
Well, right across the emerging world, we have seen inflation rates fall, and that's basically as their economies slowed. That's taken pressure off demand, and therefore inflation's come down. And I think going forward, as a general rule, that does provide lots of flexibility for those countries to ease up on the monetary policy break and provide stimulus for their economies. And of course the notable countries there are places like China, where I think we'll certainly see that happen going forward. India is a bit more problematic. Inflation's sort of come off, but it's still relatively high. They've had a monsoon which hasn't gone so well, so food prices are under a bit of pressure in India. So a little less scope in India for the central bank there to cut rates. But I think as I look across the rest of Asia, that flexibility is certainly there. Lower inflation basically means and will mean lower interest rates going forward. Now, one concern, of course, is that everyone knows America's had a terrible drought that's pushed up the prices of things like corn. So far, there's been little impact in terms of rice prices, but obviously that rise in the price of corn in the US could feed through to higher feed costs, for chickens and pigs and so on globally. So that does add a bit of inflationary pressure around the world. I don't see that being a major problem though. I think, yes, it could cause some central banks to hold back a little bit, but at the end of the day, the underlying pressures in a world of very constrained growth, lots of spare capacity, the underlying pressure is for inflation to fall. So I don't see the drought in the US causing major problems.
Just finally, Shane, the US experienced restrained expansion in the June and early July period. Can you provide an update on what you see occurring over the next few months for this economy?
Well, the US economy has sort of had some mixed readings of late. We saw some good numbers coming around the end of 2011, the start of this year. And of course, as we went into the June quarter, things softened off a little bit. Still growing. That's the good point to note about America. It's still growing, growth of around 1.5% to 2%, which is still a reasonable outcome. It's just that it's not enough to bring down the unemployment rate on a sustainable basis. And when you look at indicators for business conditions, retailing and so on, they're still sort of motoring along, but not a growth rate which is strong enough for the Federal Reserve to be comfortable. So at the end of the day, my feeling is that the US economy will probably continue to sort of muddle along with 2% sort of growth. We'll probably see some more stimulus from the US Federal Reserve, which will keep that economy going. But I'd really characterise the US economy as being a bit like a person that's in a coma. And the Federal Reserve is the drip. It's keeping the patient alive until they can be healthy again to come out of the coma and walk away. America's not quite in that state yet, but the key role being played by the US Federal Reserve is to keep the economy alive, just ticking over. And in fact, from a longer term perspective, even though the recent indicators of the US have been a bit mixed, there are some positives in the US. The housing sector looks to me like it's bottomed. They've got the oil shale gas revolution going on, which is a huge game changer for the US. We've got a bit of a manufacturing renaissance. Companies around the world relocating production to America because the costs are so low. And of course, America's still got a tech boom, an IT boom going on. So yes, softish growth in the near term, but I can see signs of healing in the US economy, which ultimately I think will enable the patient to come out of that coma and start walking again.
Shane, thank you so much for your time today.
My pleasure, thank you.
And that brings us to the end of September PD sessions. Thanks for watching. If you have any feedback or questions, please drop us a line at pdcontent@kaplan.edu.au. I'm Ron Wilson. I'll see you again next time.